human capital, clusters of activity, and deeper societal attitudes towards risk aversion and risk attitude remain very important. An example in this respect, which is closer to the banking sector, is the progress to create a more integrated and liquid market for securitized products. The introduction in 2019 of the securitization regulation, as well as the simple, transparent, and standardized framework, which has a preferential prudential treatment under the capital requirement regulation, represented an important step forward. However, the framework has not produced the expected results. The work to enhance the securitization framework continues to be ongoing. We at the EBA have published, together with the other ISAs, in December of 2022, a review of the prudential framework for securitization to try to improve its efficiency and risk sensitivities. It is acknowledged that the lack of revival of the US securitization market should be found in the interplay between demand and supply conditions, and that no simple regulatory solution is identifiable. Only a holistic and comprehensive review of the current framework and the functionings of the market could have the hoped effects. In the meantime, the EU securitization market is a fraction of what it was. Securitization's volume amounted to 2 trillion euros in 2010 and was at around 500 billion in 2022, so 25% of the size than in 2010. In contrast, the outstanding volumes of securitization in the US in 2022 were well above the levels prior to the global financial crisis. A third aspect, from my point of view, relates to the lessons that can be learned from the persistence of fragmentation in the banking union. As I mentioned before, financial stability concerns by member states and possible mutualization of risks in cases of bank failures and resolution have been at the core of the reluctance to further progress towards European integration in the banking sector. Here, I'm more optimistic for the prospects for European integration in capital markets. The economies of scale in capital market activity, the rationale for concentration of market activity in a single entity or location, to create deep liquidity pools, to create a specialized knowledge in financial markets is clear to me. It is also clear that Europe has too many, I would say, national markets in a number of financial products, calling the equity, derivatives, or fixed income, all of them too small. The case for consolidation and specialization is clear. At the same time, the concerns that concentration may impact financial stability at the level of a member state, or possible risks for mutualization in case of failure, which are typical concerns within the context of the banking union, I think they're much, much less relevant or even irrelevant in the context of capital markets. A fourth lesson that I would like to extract has to do with the creation of pan-European financial firms. The creation of the banking union has led to some consolidation of banking services across the EU. Most of those consolidations have taken place along national borders. However, as I mentioned before, cross-border consolidation of banking groups has been quite limited, despite the creation of the single rule book and the creation of single supervision at the European level. Banks executives constantly argue that the economics for cross-border consolidation do not currently exist in the EU. There are, however, certain segments of banking activity where cross-border provision of services by consolidated groups has been increasing in the last decade. This is happening precisely in those areas more closely related to capital market activity and corporate banking, in investment banking, in trading, in corporate lending, and similar activities. In this aspect, I see potential for the creation of larger pan-European financial players in the capital markets if the conditions are favorable. A fifth reflection has to do with the effective provision of cross-border retail financial services in the EU that has been mentioned already as well by Alexandra. The experience from the establishment of the banking union shows that progress here is difficult. Most of the retail lending and banking services provided to EU citizens and SMEs remain within national borders. Cross-border provision of such services, with the notable exception of payments, remains very low. A large number of well-identified differences across member states of very different nature, call it insolvency regulations, fiscal treatment, cultural attitudes towards risk, tradition, and competitive dynamics, made the expectations of developing truly European products through sequential regulatory harmonization and supervisory convergence very difficult from my point of view. Here, a truly big bang approach will be needed if progress needs to be made in this or wants to be made in this front. Let me conclude. I do believe that deeper capital markets in Europe will help us in addressing some of our challenges. I think the experience from banking integration can help us in better achieving this goal. On the negative side, I fear that we lack the sense of urgency and existential crisis to make progress. We need to be convinced that deeper capital markets are not just nice to have or good for the financial sector. They are existential for the future of the Union and for the well-being of our citizens. On the positive side, financial stability concerns on financial stability that have slowed integration, on the positive side, concerns on financial stability that have a slowed integration within the banking union are much less significant in capital markets, while the economic benefits for the specialization and economies of scale are much larger in capital markets. This should drive faster integration if the conditions prove adequate in that area. Thank you again very much for your attention.